Hello, I'm Jason Kelly. Thank you for joining me today. In this video, I'll consider whether you need to take any steps to prepare for higher interest rates on the way. According to the Federal Reserve, we should expect higher interest rates. They have signaled that higher rates are on the way. This, for example, is from the Telegraph. We'll put it up on your screen here in a sec. Dated March 3rd, 2017. The headline reads, Federal Reserve Chairman signals interest rates will rise in March. And down below the highlight, Janet Yellen said a rate increase would likely be appropriate at the Fed's next meeting on March 15th. There are three primary areas of your financial life that you'll want to review in preparation for higher rates if you need to take any action at all. As you'll learn in this, you probably don't need to do a thing, but the media always makes it seem like there's imminent action to be taken. So this will help you review whether that's actually the case for you. The three areas are stocks, bonds, and debt. So let's cover each of those in turn. In the area of stocks, the thing to not do is sell everything you own because you've been told you should never fight the Fed and that lower rates are on the way, lower stock prices rather, are on the way as interest rates rise. This is a common warning from stock market pundits who are usually bearish because that gets them the most attention. Let's look at another example of that. From Business Insider on December 8th, 2016, so a few months back, the headline read, Rising interest rates are a bad omen for stocks. This was written by Brian Marr at the Daily Reckoning. Down below, he's sharing a quote from John Huesman at Huesman Funds, who he refers to as this Huesman fellow, flopping sweat, his eyes a bulge and his pulse running to three-quarter time. Already typical media sensationalism. But here is the quote from Huesman. The present combination of overvalued, overbought, over-bullish conditions coupled with rising interest rates is a combination that has most often been associated not only with emerging bear markets, but with market crashes. There we go again. So a market crash on the way. One of the reasons, rising interest rates. Now this was just ahead of the Fed's rate increase in December. So again, it was timely and on people's minds then. What happened following this warning from John Huesman? Well, the S&P 500 gained 6% in the 3 months following. So keep in mind, all these forecasts need to be accompanied with a major grain of salt. Now, this is even more interesting with that. Warned against what to do with stocks ahead of the rate increases, right? Bad for stocks. Rising rates, bad for stocks. And then last week, after the Fed's full court press that they're going to raise interest rates this month, we see now pundits are saying the Fed's desire to raise rates is a vote of confidence in the economy and that that's going to be good for stock prices. So remember once again, nobody knows nothing. All right, before they were going to be bad for stocks, now they're going to be good for stocks. They don't know and we don't know. However, if you are actively managing a stock portfolio, I don't think you should be, but if you are, sector allocation can make sense as we go into a higher rate environment. Let's look at what that's all about. Now, of course, financials do well when rates rise because their profits go up. As you can see here on the chart of the Financial Select Sector Spider, XLF, over the past few months. Look on your screen there, I'll talk through it. The beginning of December, it took a shot higher as we headed into that December rate increase. And most pundits at that time were saying that's why it went up, is because the Fed's raising rates, so that's going to be great for banks. And so up went the XLF ETF. Then it went sideways for a couple months. At the end of January, and into early February, it kind of bottomed out there. I guess on the 23rd of January, that's when it got that first shot higher. Now, rising rate expectations weren't the only pressure then, right? That's when the Trump administration came into the White House. Lots of talk at the end of January about reducing regulations and changing the interest rate and getting the economy going and help. So pro-business Trump administration was also part of this boost. But you can see it did keep going up. It accelerated into the end of February as investors started thinking more that a rate increase is probably likely. So will financials keep going up? There's a pretty good case to be made, right? Banks are in the business of lending money. If rates go higher, then profits should increase. So it does make sense that that would be going up. Finance is not alone, however. The classic 5 defensive sectors were covered by the Financial Times a year ago when people were talking about rising rates, and they still apply. So look up on your screen here. I'll show you an excerpt from an FT article from a year ago. The highlight here is 5 sectors gain during rising rates and fall during falling rates, and all can be called economically defensive sectors. In descending order, they are utilities, telecoms, energy, healthcare, and business equipment. So there you go. If you want to try gaming this and trying to make a little bit more than the general market, maybe those defensive sectors will work out for you in a higher rate environment. If you are running my signal system, and you should be, I can't emphasize that enough, then there is absolutely nothing you need to do. You need to worry about none of this because the system is already set to handle fluctuating prices. Since nobody knows where the prices will fluctuate, that's a good thing. It will react appropriately to wherever stock prices go. The system is already set. Nothing you need to do. We thrive on changing prices, not constant up or down. All right, so how about bonds? Let's look at what you should do with bonds. If you actively manage a bond portfolio, consider laddering. What's a bond ladder? Here to answer that is Neighborly, the municipal bond broker, and this is an excerpt from neighborly.com. What is a bond ladder? It reads, a bond ladder is a way of structuring individual bonds with staggered maturity dates. The rungs of the ladder are made of bonds that are spread out to mature at different times over a course of months or years. When payment on one bond is received, it can be reinvested in a bond with a maturity date at the end of the ladder. The idea here being that you don't know where rates are going to go. Neither do I. Nobody does. The Fed doesn't even know. So because it's an uncertain rate environment, you want to get as much out of your bonds as possible, and you'll take the money from the lower yielding ones and put it in higher yielding ones on this ladder. And here's a wonderful image of how this works, also from neighborly.com, that municipal bond broker. It shows a ladder, and the higher yielding, longer term bonds are at the top of the ladder. And then we come down gradually to the shorter term, lower yielding bond funds. And see this arrow going up here. As you get payments from these guys, you move them up here to the higher paying, higher interest rate bearing bonds. Note at the bottom reads, maturing principal is reinvested in a new bond at the long end of the ladder to capture higher interest rates. This makes sense. If you are in a general bond fund, which I believe you should be and which my system uses, you don't need to handle this manually because that's what the bond fund is doing. They are going to naturally capture higher interest rates as they become available over time. So for example, if the rate rises 1 whole percentage point this year, they're going to be gradually moving their capital into those higher yielding bonds. And so in the beginning, bond prices will go down as interest rates increase. But eventually, the bond fund will catch up and start getting bigger payments back from those higher interest rate yielding bonds. And so this will take care of itself. And most of the profit, by far, most of the profit from a bond fund comes from those payments along the way. So you'll be fine in a general bond fund. Plus, with my system, you'll be moving money back and forth between the stock and bond funds, allowing those fluctuating prices on both sides of the equation to work in your favor in some time periods. Finally, debt. I should give you a personal finance tip right up front here, something you should already know, but many people forget, and that is simply this. Do not ever borrow money to buy an asset that decreases in value. Don't ever do it. You pay out of pocket for those. So things like vacations, dinners, nights at the movie or the opera, if you're into that kind of thing. Cars, for example, anything that depreciates or is not worth more later, then you don't want to use borrowed money to pay for it. You pay out of pocket for that. Because if you borrow money for it, you pay the interest expense on top of the price of that item. What it is okay to borrow money for is something that will increase in value later on. The best example of this is home values in the United States. Many Americans own a home, and one of the benefits of that is that it'll be worth more in later years than what was paid for it, even if you include in all the interest from the mortgage. So that can make sense. And you might have a mortgage. What should you do with that mortgage? The obvious thing is to refinance that mortgage if rates are going up. But it's not that simple, and here's why. To see why this is so tricky, look at this chart of 30-year rates from the St. Louis Fed. This is over the last 5 years. Some key points to notice here as you look on your screen. It bottomed below 3.4% at the end of 2012. All right, and then we got a huge surge higher there, a huge surge. What was that huge surge on in the middle of 2013? Was that because rates went up? No, that was the taper tantrum when then Federal Reserve Chairman Ben Bernanke said they were thinking about tapering their stimulus program, tapering their bond purchase program, removing some stimulus. Investors thought, oh my gosh, this means higher rates are on the way. We're going to get ready for it in advance. And that's what sent the rate higher. So nothing actually changed. It was just emotions, animal spirits, wrong reaction to what the Federal Reserve had said. That's the biggest jump on the chart, something that had nothing to do with actual rates. Then we went sideways for a while. We spiked just a little bit in December 2015 when the interest rate went up just 25 basis points, or 0.25%. Look at that. You can see right there at the end of 2015, just that little tiny jump there, kind of in line with normal fluctuation in the rate along the way. Where do we see another big jump? On the far right side of the chart, and that's last December when the rate did go up another 25 basis points. So look at the mixed evidence on this 5-year chart of the 30-year mortgage rate. The biggest increase on the whole chart had nothing to do with a rate change, but just the expectation and all the media chatter about a rate change. Then when we got the first actual rate change of the cycle, the increase, there's just a little bump in the 30-year mortgage rate. And then the next one, there was quite a big jump in the 30-year mortgage rate, making it very hard for you to know, and me to know, or anyone to know what is going to happen next. Now, what I suggest you conclude from this is that we're sort of right in the middle. If you look at that chart, we're right in the middle from 3.4% where the bottom was, and what they're projecting it'll be at the end of this year. The Mortgage Bankers Association says in the fourth quarter, the 30-year rate will be 4.7%. The National Association of Realtors guesses 4.6%. So we're right in the middle right now. It's hard to know where it's going to go next, but I think it makes your job a little easier because there's really no reason to jump to action right now because you don't know if the action's going to be right. I would say, looking at this evidence, you'd probably be able to get 4% later this year, and maybe you hold out for that. And if you don't quite get it, no big deal, because we're going to be in a pretty tight range where you're already at. All right, to recap, if you're running my signal system, you don't need to do a thing. You're right where you need to be. You're in only 2 funds. The prices will change, the system will react, and you will be fine. If bond prices go down, later you'll make more money off the payments, and anyway you're moving capital back and forth, you are set. If you're actively managing your stock and bond funds, consider buying defensive stock sectors with your stock money and consider creating a bond ladder, as we talked about earlier, to be ready to take advantage of higher interest rates on the way. For your mortgage, just sit tight, hope that you can get 4% later this year, but there doesn't seem to be any reason to rush out and do something right now. That'll do it. Thanks for sticking with me. If you like this video, please indicate that by giving it a thumbs up on YouTube, and I'd love it if you subscribe to my channel. Kelly Letter subscribers, I will see you Sunday. Everybody else, have a great weekend.